Welcome to Charged Alpha's Q1 2026 earnings coverage. Today we're diving into Alcoa Corporation, ticker AA, the aluminum giant that just completed one of the most important transformations in its history, only to stumble on its first post-deal earnings report. I'm Hudson, joined as always by Lana.
And that stumble is worth unpacking carefully. Alcoa missed both earnings per share and revenue expectations for Q1 2026, sending the stock down nearly 8% on earnings day. The question is whether this is a speed bump for an otherwise dramatically improved company or the start of something more concerning.
Exactly. And Alcoa's story right now is genuinely compelling. A company that went from drowning in acquisition debt to holding $1.35 billion in net cash in a matter of quarters, all while operating under a 25% tariff umbrella that's reshaping the U.S. aluminum market. Let's break it all down. So let's set the stage. Alcoa was founded in 1888, one of the oldest industrial companies in America, and it's headquartered in Pittsburgh, Pennsylvania. The company operates in three segments: bauxite mining, alumina refining, and aluminum smelting.
What makes Alcoa unique is that it controls the entire upstream aluminum supply chain, from digging bauxite out of the ground in Australia and Brazil, refining it into alumina, and then smelting that alumina into primary aluminum. Very few companies in the world do all three at scale.
When you look at the numbers, 13,900 employees, operations on 6 continents, smelters running on hydropower in Iceland and Norway, this is a genuinely global industrial enterprise. The company generates about $12.7 billion in trailing 12-month revenue.
The big strategic move was the 2025 acquisition of Alumina Limited. That deal gave Alcoa full ownership of the AWAC joint venture, which stands for Alcoa World Alumina and Chemicals. AWAC represents roughly 30% of global alumina refining capacity. That's not a small position, that's a near-dominant stake in a key industrial input.
Alumina is the intermediate product between raw bauxite and finished aluminum. It's a commodity in its own right, and having control of 30% of global supply gives Alcoa pricing power and cost advantages that competitors can't easily match.
The alumina deal cost $2.2 billion and briefly loaded the balance sheet with about $5 billion in debt. But, and this is remarkable, Alcoa paid that entire debt pile down to essentially zero by the end of 2025. We're talking about a company that went from $5 billion in debt to a net cash position of $1.35 billion in a single year.
That kind of financial discipline is not typical of a commodity company. Usually these deals take years to pay down. Alcoa essentially funded the entire alumina acquisition through its own cash generation.
With a caveat, Q4 2024 was an exceptional quarter with nearly $4 billion in revenue and strong margins that helped fuel that paydown. Q1 2026 is showing a more normalized cost picture.
So who's running this thing? Alcoa is led by William F. Opplinger, Bill Opplinger, who became CEO in 2022. He came up through the finance side of the business, serving as CFO before taking the top job.
Opplinger's background is significant here. A CFO turned CEO typically means financial discipline and capital allocation rigor, exactly the qualities you want when you're integrating a $2.2 billion acquisition. The rapid debt paydown has Opplinger's fingerprints all over it.
He's been focused on 3 things since taking over: operational efficiency, balance sheet optimization, and positioning Alcoa for the energy transition. On efficiency, Alcoa has been advancing its AP60 smelting technology and the ELYSIS zero-carbon aluminum process, which is a joint venture with Apple.
The ELYSIS partnership with Apple is strategically interesting. Apple needs zero-carbon aluminum for its products and has essentially co-funded the R&D to help Alcoa develop it. That's a customer funding your capital expenditures. Hard to beat that dynamic.
Opplinger has been candid about the challenges. Aluminum is a commodity business, and you live and die by the London Metal Exchange price. But the thesis he's executing is that if you control enough of the supply chain and run it efficiently, you can generate returns even in down cycles. All right, let's talk numbers. Start with valuation. Alcoa is trading at about $64.94 a share, giving it a market cap of roughly $17 billion.
On traditional multiples, it looks reasonably priced. trailing PE of about 16.7 times, price to sales of 1.35 times, and an EV/EBITDA of about 9.3 times. For a company with a dominant supply chain position and essentially no debt, those multiples seem modest relative to the earnings power story.
Now the Q1 2026 numbers. Revenue came in at $3.19 billion, a miss versus the $3.28 billion analyst estimate. Adjusted earnings per share was $1.40, missing the $1.60 consensus. Both top line and bottom line came in short.
The EPS miss is notable, but look at the underlying financials. Gross profit for the quarter was $681 million on $3.19 billion revenue. That's a 21% gross margin for Q1. The trailing 12-month gross margin is just 7.5%, so Q1 was actually well above the full-year trend.
That 21% Q1 gross margin versus 7.5% trailing tells an important story. The TTM margin reflects the difficult first half of 2025 when integration costs and lower aluminum prices were dragging results. Q1 2026 shows the underlying business running much cleaner.
Operating income for Q1 was $570 million, an operating margin of about 18% for the quarter. EBITDA came in at $732 million for an EBITDA margin of nearly 23%. These are strong absolute numbers even if they missed estimates.
Net income for Q1 was $425 million. The GAAP diluted EPS works out to $1.60, which is right at the consensus estimate. The miss was on the adjusted basis. So the gap between the reported number and the estimate is largely about one-time adjustments.
Now the balance sheet, and this is genuinely extraordinary. Cash on hand, $1.35 billion. Total debt, $1 million on a $17 billion company. Net debt position, negative $1.35 billion. They have more cash than debt by essentially the entire cash balance.
For a company that 18 months ago was carrying $5 billion in acquisition debt, this is a remarkable turnaround. Current ratio is 1.48, and the quick ratio is 0.88. The balance sheet is about as clean as you'll find in the basic materials sector.
On cash flow, here's one yellow flag. Operating cash flow in Q1 was negative $179 million, and free cash flow was negative $298 million. That's a reversal from Q4 2025, which generated $367 million in operating cash.
How much of that Q1 cash flow negative is seasonal versus structural? Aluminum companies typically build working capital in Q1. They're stocking up inventory and building receivables ahead of stronger demand in Q2 and Q3.
Seasonal is the most likely explanation. Look at the trajectory. Q2 2025 generated $488 million in operating cash. Q3 was $255 million. Q4 was $367 million. The trailing 12-month free cash flow is still positive at roughly $287 million. Q1 weakness is a pattern for aluminum, not a red flag.
For the forward picture, analysts expect revenue to scale significantly as the alumina acquisition fully ramps. Consensus revenue estimates for 2027 are $14.8 billion. That's nearly 20% above the current trailing run rate. EPS estimates for 2027 are around $6.82.
At 682 cents in forward EPS and a current price of $64.94, you're looking at a forward PE of about 9.5 times on 2027 numbers. That's genuinely cheap if Alcoa can execute, but aluminum companies have a habit of missing those out-year estimates when the commodity cycle weakens.
On margins for Q1 in isolation, gross margin 21.3%, operating margin 17.9%, EBITDA margin 22.9%, net margin 13.3%. Strong quarterly performance. It's the TTM drag from weak first half 2025 that compresses the trailing numbers.
Dividends. Alcoa pays 40 per share annually, which is a yield of about 0.6% at current prices. The payout ratio is just over 10%, meaning the dividend is extremely safe and there's ample room to grow it as earnings scale up.
Return metrics. Trailing return on equity of 18.7% and return on assets of 7.1% on full year 2025 figures. The ROE is actually quite good for an industrial company. It reflects the improved profitability and the dramatically leaner balance sheet after debt paydown. All right, what does Wall Street think? After the Q1 miss, the analyst community is fairly split, but the tone heading into earnings was decidedly more optimistic.
The notable move was Morgan Stanley upgrading to overweight on April 9th, just 1 week before earnings. That upgrade came from equal weight. Then Q1 came in light and the stock dropped 8%, so Morgan Stanley's timing was challenging for anyone who followed the call the day it dropped.
JP Morgan is staying neutral, BMO Capital is market perform, B. Riley Securities and Citigroup are both buy. Wells Fargo downgraded to equal weight in January, so roughly half positive, half neutral.
Bank of America is the outlier at underperform, one of the more bearish voices on the street. Their concern centers on Chinese aluminum overcapacity and LME price pressure that could erode Alcoa's margins regardless of domestic tariff protection.
Price targets are generally in the range of $70 to $85, with a consensus average somewhere around $79. That implies about 22% upside from the current price of $64.94. Decent, but not a screaming buy signal.
The consensus was more bullish heading into Q1, and the miss will likely prompt some target cuts in the coming days. The critical question for the street is whether Q1 margins normalize in Q2 as aluminum prices recover seasonally.
On recent earnings history, Q4 2025 was a blowout. EPS came in at $1.26 against the 93 estimate. That's a 36% beat. Revenue beat too at $3.45 billion versus $3.28 billion expected. Q3 2025 beat on EPS but slightly missed on revenue, and now Q1 2026 is a double miss. 2 beats, then a miss. Let's lay out both sides. Bull case first. Alcoa has a tariff-fortified competitive position right now. The 25% tariffs on aluminum imports mean U.S.-based producers are competing against structurally higher-cost foreign aluminum. That's a real moat that didn't exist before 2025. Add to that the cleanest balance sheet in the company's modern history. Net cash of $1.35 billion means Alcoa can weather a prolonged commodity downturn without financial distress, something that would have been a serious concern when they were carrying $5 billion in debt from the alumina acquisition.
The bull case also includes the demand side of the equation. Aluminum is going to be a critical material for the energy transition. EV battery enclosures, solar panel frames, wind turbine components, power grid infrastructure, all require aluminum at scale. If you believe in the clean energy build-out, you need to believe in aluminum demand.
And then there's the AWAC ownership play. Controlling 100% of AWAC means Alcoa captures the refining margin it previously shared with JV partners. Combined with 2027 EPS estimates of $6.82, implying a forward PE of just 9.5 times, the valuation case for bulls is compelling if management executes.
Now the bear case, and I think it's substantive. The Q1 miss highlights how thin Alcoa's margins actually are on a trailing basis. A 7.5% TTM gross margin means that relatively small moves in aluminum prices or energy costs can swing the company from profitable to near break-even. That's a commodity company vulnerability that a clean balance sheet doesn't fix. China remains the elephant in the room. China produces about 60% of global aluminum, and Beijing has been willing to tolerate significant excess capacity for geopolitical and employment reasons. If Chinese exports flood LME markets, Alcoa's pricing power deteriorates quickly. Tariffs help for U.S.-bound sales, but Alcoa also sells into international markets.
The bear also points to energy costs. Those hydro-powered smelters in Iceland and Norway are efficient when power prices are stable, but European energy markets have been volatile since 2021. A spike in European power costs hits Alcoa's smelting economics hard and quickly.
And the tariff risk is real. Tariffs are a policy, not a law of nature. If the trade environment shifts again, that competitive moat disappears overnight. When you own Alcoa at these levels, you're making a political bet alongside the fundamental bet, and political bets are harder to underwrite.
On peer comparison, Alcoa is somewhat uniquely positioned. There's no perfect domestic aluminum comp at scale. Century Aluminum is the most direct comparison. Another U.S.-based primary aluminum producer, trading at a price-to-sales of about 0.22 times, reflecting its much smaller scale and higher cost structure versus Alcoa.
Rio Tinto is the global mining major with an aluminum business comparable in scale to Alcoa. Rio trades at about 9.8 times earnings and 1.45 times revenue, similar multiples to Alcoa, but with a much larger diversified revenue base where aluminum is just one segment, not the core business.
Eastman Chemical is a basic materials sector peer on the valuation screens, though it's a specialty chemicals business, not a direct operational comp. The relevant read-through there is just the sector multiple discount. Materials companies generally trade at a discount to the broader market.
The honest takeaway is that Alcoa, with its supply chain scale, vertical integration, and now clean balance sheet, should trade at a premium to a generic aluminum producer. Whether the current 16.7 times trailing PE is the right premium is the central debate for investors right now.
In the options market, the post-earnings reaction was visible. The put-call ratio ran above 1.1, with put activity spiking on the Q1 miss. The $60 and $65 put strikes were most active, with traders pricing in further near-term downside risk from here.
Implied volatility is running around 45%, elevated for a basic materials name, reflecting both the commodity cycle uncertainty and the post-earnings ambiguity about whether Q1 is a one-time issue or a trend. The market is clearly not giving Alcoa the benefit of the doubt yet.
The $70 calls have been attracting interest too. That's the recovery trade, betting on Q2 improvement and tariff benefits materializing in the share price. So you have a split market, protective puts near-term, speculative calls medium-term. On insider activity, no significant buying or selling in the 6 months ahead of Q1 earnings, which reads as neutral.
What's interesting about the insider inactivity is that the stock ran from a 52-week low of $22.68 to a recent high of $75.70, a 230% move. And nobody inside the company was selling into that rally. When insiders don't sell into a multi-bagger, you can interpret that as confidence in the long-term thesis.
All right, what are the key watch points going into Q2? First, LME aluminum pricing. It's the single biggest driver of Alcoa's results. Watch for sustained moves below $2,400 per metric ton, which starts to pressure margins materially.
Second, cost trajectory. The Q1 miss was partly a cost story. In the next earnings call, watch Alcoa's unit cash cost per metric ton of aluminum. Management guides for this explicitly. If costs are coming down from Q1 levels, the thesis is intact. If they're sticky or rising, the bear case gains credibility.
Third, tariff developments. Any trade policy news affecting aluminum imports belongs on your radar. And fourth, AWAC synergy progress. Management commentary on cost improvements from full ownership of the JV is a key signal of whether the acquisition thesis is tracking as expected.
Bottom line, Alcoa has done the hard work. It paid down debt, integrated a transformative acquisition, and positioned itself in a tariff-protected domestic market with a balance sheet that's essentially pristine. The Q1 miss is a setback, but the underlying structure is dramatically stronger than 18 months ago.
The key metric to watch is the Q1 to Q2 margin trajectory. If gross margins can hold near 20% on a sustained basis, as they did in Q1 2026 in isolation, the 2027 EPS estimate of $6.82 starts to look achievable. At that EPS and a reasonable 12 to 15 times commodity multiple, you're looking at a stock in the $80 to $100 range.
The risk-reward here depends entirely on your view of aluminum prices and tariff durability. If you believe in both, Alcoa under $65 with a net cash balance sheet is an interesting setup. If you're skeptical of either, the thin trailing margins don't give you much cushion.
For a commodity company with significant operational leverage, I'd call Alcoa a show-me story right now. Q1 was a miss. Q2 will tell us whether the underlying improvement is real or a one-quarter event.
We'll leave you with a thought from CEO Bill Oplinger on the Q1 2026 earnings call. The aluminum cycle always looks worst right before it turns. The companies that survive downturns with clean balance sheets are the ones that win the next cycle. With $1.35 billion in net cash and essentially no debt, Alcoa is positioning to be exactly that company.
And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. And real quick, if this Alcoa breakdown helped you see something you would have missed, we're doing this for every major earnings report. Hundreds of Russell 1000 deep dives, new episodes every week during earnings season. Subscribe and you'll get one of these for every stock on your watch list. Takes 2 seconds and you won't miss the next one.
That's going to do it for our Q1 2026 earnings deep dive on Charged Alpha. Thanks for listening.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.